Okay, chapter 17. Let's do this quick overview of the chapter 17 before we continue with today's part, which will be uh, part with when we're doing the investing and financing activities, the cash flow statement. But first, cash flow statement is probably the one of the most important statements. I mean, all the them is important, but the cash flow gives you idea. Is this company generate cash or not? From where they're generating cash, what's the source of the cash they're generating, and from where the cash going, if the cash going somewhere. Either investor, either lender, you chasing profit for yourself. That profit, if you're a lender of the money, it's going to come from interest. For the investor, it's going to come for the dividend. So you don't want stock dividend. You don't want interest on paper. You want actual cash. So that's going to come only and only from cash. That's why you need to know, is this company has ability to generate cash? Even if they have income, that doesn't transfer directly to the cash. So let's see how was it. At the beginning of the period, we're going to prepare the balance sheet. At the end of the period, we're going to create a balance sheet. So the balance sheet is prepared only at point of time, at the beginning of the period, end of the period. You know, in accounting, the shortest period is 1 month. Then, within that month, something happened in the company. Where can we see what happened in the company? In the income statement, you're going to see, is the company generating revenue? What are the expenses for that period? What's happened with the retained earnings? Obviously, if the company generating income, that's going to show in the retained earnings statement. And the last thing is the cash flow. What's happened with cash? And we're doing dissection of the cash flow, of the cash account. Starting, see what the beginning balance is, what came in the cash, where the cash went, and ending balance. Beginning balance plus the cash that came in minus the cash going out is going to give you the ending balance. Always like that. It's important because it's going to help you to predict the future, cash future. Why do we need to predict the cash future? Because you want cash. Even if you lend your money to the company, you want cash. You want to have that you confidence that this company generate enough cash to pay your interest and enough cash to pay you loan back. That's why the bank is so concerned about this cash flow statement. The funny part is, since the cash flow statement is the only statement which is not prepared by financial stuff from the accounting software, somebody has to prepare it manually. Nobody wants to do it. That's why the bank managers always asking me the question, hey, can you explain me how the cash flow statement works? Why? Because when the small company, sole proprietor comes, he dropped me some papers and I have to figure out if he has ability to generate cash. Again, the only thing the bank cares is this person going to pay me the interest and principal? That's it. Negative cash, obviously, on the operating activities, that's a warning sign. Now, what is included in cash? In cash, you have to think of if you have to pay your debt now, how fast you can get the cash. So what will be that? Anything that you have as a cash in the bank account, plus anything that you have in the stock market, which can be sold right now, even with loss, but you're selling it right now. Anything that's sitting on the GAC or guarantee investment certificates, which are cashable. So anything that you can be converted to cash in the short period of time, that's considered cash and cash equivalent. Now, the form of cash flow we have for the operating activity, we have two. One is direct and one indirect method. Last time I showed the indirect method. And what's the difference between the indirect and direct method? But there are three basic categories in the cash flow statement. One is the operating activity, second was the investing activity, third one financing activity. Each of those sections are prepared separately and show different things. Operating activities, again, shows the company ability to generate cash from the operating. and operating activities only, which including the current assets, current liability, working capital. Operating cash, remember, that's your working capital. Anything current. Then we're going to investing. Investing, chasing only and only long-term assets. What's happened with the long-term assets? Increase, decrease, new purchases, sales, and if you have investment, have you invested, have you get the money back. And then we're going to financing activity. Financing activity is how we finance our capital, which is the assets, with the long-term debt and equity. So did we get dividend? Did we pay dividend? Did we issue shares? Did we borrow money on the long term? Did we pay long-term loans? What exactly happened with the cash? So in very briefly, operating activity dealing with the current assets, current liability. Investing dealing only with the long-term assets. Financing dealing with the long-term liability owner's equity section. Discontinue operation, we have to do separate for the discontinued operation. How we treating different things in the income on the statement of the cash flow depends on the nature, but the general rule is in operating activity we always include by default interest receive interest payments because we consider the interest that the company generate even with the investing activities, those are for the operating purposes. It's not something that you're going to do it for the investing purposes. Again, the company is open to generate cash from the operating activity, which can be merchandising activity or manufacturing activity or service activity. Primary goal is not to receive the interest. We're not a bank institution. The bank institution, however, interest received will be different, treated as a revenue there. I mean, it's always going to be revenue, but that will be the main activity. That will be part of actually the operating activity in the bank. But let's leave the bank. The next thing is dividend received. We're always going to treat it part of the operating activity, and interest payment that we're doing part of the operating activity. Only and only the dividend payments, cash dividend payments, we're going to treat them as part of financing activity. First thing that we have to do is to understand what is cash, what is not cash. Cash is every time when the cash is exchanged. So if you have sales and accounts and you're creating accounts receivables, there's no cash. So the cash in that case is going to come when you collect the accounts receivables. The dividend received, yes, is counted as a cash dividend, is part of the operating activities. Dividend paid is also considered cash dividend, but we're going to look at the question and we're going to make sure that we understand. Because if it's a stock dividend, there's no cash involved, so we don't have to do anything. We're dealing only and only with the transactions which involve cash on the debit or credit side. If the cash is not part of the debit and credit side, nothing. We're not dealing with those transactions. Those are not part of our objectives for creating the cash flow statement. Free cash will be the net cash provided by the operating activities minus or less all the cash payments for investments in property and long-term assets. And that will be the free cash that company can have. Now let's go again briefly with the preparation. We have the indirect method we're using the indirect method for the cash flow statement. The difference is that we're starting with the net income for the period. We're starting from the net period, and then we're making adjustments to bring that net income to the cash-based net income by reversing all the accrual net income elements in order to eliminate non-cash transactions. For the indirect method, as we saw last time, first thing is start with the net income. accounting net income or general accepting accounting principles net income, then we have to either add back, either subtract. We're going to add back anything which is increasing expenses, but we don't have to pay cash, and anything that reducing the revenue, but we don't have to pay cash. What will be those elements? For the expenses will be depreciation or amortization and losses. On the gain side, we're going to see if we have income, if we have some income which is accrued income and gain which give the raise on the revenue side, we have to deduct those one from the net income in order to eliminate the effect. We already started with this. We finished with this on the operating activities. We're starting with the net income. Then we're going looking the elements and see is there anything here which is non-cash item. We're chasing for gain or losses, and we're chasing for amortization expense. If we find anything, we're thinking what's the effect on the net income. If it's gain, obviously that increasing the net income. So in order to eliminate that gain, I have to reduce it by deducting $19 from the $100 net income. Amortization expenses, the opposite. That's reducing the net income. So in order to eliminate the effect of the expense, I have to add it back. And then after we do this, so after we come up with from the accrual income or general accepting accounting principles income, then we're moving to the cash income. Once we move to the cash income and come up with the cash income, then we start chasing the changes in the working capital. What's the change in accounts receivables? What's the change in interest receivables, inventory, prepaid expenses? And then we're chasing current liability, which is accounts payable, salary payable, accrual liability. Once we finish with those one, our job is done. And then we can have the net cash flow from operating activities. Today we're going to practice again questions. We may catch the question that we did last time again. Again, starting with the net income, then we're adding back the expenses, which are reducing the income, and we're subtracting the gain, which is increasing our income to eliminate the effect. Once we do that, start chasing the changes in the working capital. Those are the effects that different items going to have on the cash flow statement on operating activity, either increasing, either deducting. You don't have to remember those things. That's the beauty of here. You don't have to remember anything. Just think logically. Now, investing and financing activities. Those are the interesting activity which are, for them, there's no direct or indirect method. They're calculated in the indirect and direct method, that is the same calculation. So there's no direct and indirect on the investing or financing. You're just preparing the way you have to prepare. Now, what's gonna give the raise for the investing activity? Anything that the company investing for the long-term sustainability. That will be property, plant, equipment, intangible assets, investments, receivables. Many company in this case lending money. For the investing and financing section, again, we're gonna keep going. First, we're gonna start with the income statement amount, which has been already adjusted through the operating activities. And we have to get the changes which are related to the balance sheet accounts. We have to be careful with the revenue expenses and changes, adjustments on the changes of the related balance sheet accounts. Example will be property, plant, and equipment. Beginning balance net of amortization. Net amortization means amortization has already been taken. Is 525,000. Ending balance of that account is 1,087,000. There were new acquisition for 735. On the income statement, we have amortization expense of 43,000, which already been normalized on the operating activity under indirect method. And we have $19,000 gain on the sale of the property, plant, and equipment, which also been normalized on the operating activity. Now the question is, how much proceeds we receive from the sale of this asset? In other words, is the cash involved? Obviously, it is involved because everything has been paid in cash, and how much cash we get. So that's our objective here in this type of questions. Let's copy this and move to Excel spreadsheet and do some analytical part. We're going to think logically. Once you start thinking logically, everything's going to come. One thing that I have to tell you, don't be afraid to jump to areas that you don't know anything about. Why? Because you already have a knowledge. Just think. Don't think what you don't know. Focus on what you know and how can you use what you know to solve the problem. And accept the problem as a challenge. Don't accept it as something that you're never gonna fix. So again, we're chasing what we're chasing on the investing activity. We're chasing only one part. We're chasing the long-term assets. That's it. That's our goal. Let's move now to the last worksheet on this. That will become first, and I'm gonna move it all the way to the end, and that will be investing activities. I'm gonna make it a little bit bigger, wider, so you can see it. Little bit bigger, put some commas everywhere, and start. Now, our question was property, plant, and equipment. Beginning balance net of amortization, 525. So let's open this account. Probably to make it easy, I'm just gonna grab here one account that I can use and gonna paste it here. Now I have to rename it and change some information, but that's a way better and I don't have to waste too much time. So that's my property, plant, and equipment account. I have beginning balance, which is net of amortization, 525. Then I have ending balance, which is 87,123. And I purchase during the period I purchased new equipment for 735. Now the question is, if I get the beginning balance plus the debit for the period, am I getting the ending balance? So let's see, if I get the beginning balance plus the debits, I'm getting $1,260,000. That means something went out. Make sense? So something went out. In order to balance this, to have the equation, which is equation is beginning balance plus the debit should always be equal to the credit plus the ending balance. I have to find out from this equation, I have to find how much is my credit. That's what I don't know. And so my credit in this case will be equal to beginning balance I already know, 525,123. let's put the comma, 1, 2, 3, plus the debit for the period 735, 1, 2, 3, minus, in this case, the ending balance, which is 1,087, 1, 2, 3. And that's how we're going to solve it for the credit. So my credit should be equal to, let's calculate 525, 1, 2, 3, or let me grab these numbers from here. Should be equal to this amount plus that amount minus this amount. So I need credit of 173,123,000 in order to fix the problem on property, plant, and equipment. Once I do that, I'm beginning balance plus the debit minus the credit is going to give me the ending balance. Okay, so we know that we saw the asset. We know that here because here on the income statement there's a gain from 90,000 on the property, plant, and equipment. Plus we have amortization expense of 43,000. Let me grab that income statement and show it to you so you're not thinking from where he's getting those numbers. We don't know anything about that. Is he making something here or this is actually publicly available? It is publicly available and it's coming directly from the question. In the question, when you look at the income statement, we're going to see that in the income statement, we have this gain. We sold something, property, plant, and equipment. We sold it. We have a gain of 19,000, and we have amortization expense for 43,000. Now the question is, how can we get the cash that we received? That's my only question. How are we going to get the cash that we received? Having in mind that here we have this amount here is a net amount. Which including the amortization expense. Make sense?
Sorry, Ivan, just quick question. How
Yes.
exactly is it the amortization expense? I'm not quite understanding what's going on.
So how is this amount with the amortization expense? We already said that this one is net of amortization, correct?
Okay, yeah. Yeah, the
This is net,
5,000.
no
Yeah, that's
questions about it,
paid.
net amortization.
Yeah, that's
Now,
correct.
now in this amount, we don't know yet. We know
Yeah.
that I purchased something, 735. Right?
Yeah.
I purchased something for 735. Now, I need this to get out of my account. Make sense?
Oh, okay. Yeah, yeah.
In order to everything to make sense.
For the ending balance to be
Right, right.
1,887,000.
The question is, I'm also having amortization expense.
Okay.
So if I eliminate amortization expense from the period, how much is my net amount? So basically, let's go to the day of sale. The day of sale. On the day of sale, if I sell something, what I expect to get? Debit.
Okay.
What you're gonna get? If you sell something, what you're gonna get?
You're gonna get the asset or inventory and then
No,
you
no, 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 no. You selling it.
Oh, if I'm selling it, I get cash.
Thank you. Cash. So you're getting the cash, right? Debit cash. We don't
Yeah.
know. We don't know at this point. We don't know how much cash, which is
Okay.
fine. Which is fine, right? Our problem is not the cash right now. We don't know how much cash.
Okay.
Why we getting the? Let's think logically. Why we getting cash? Because we're selling something, correct?
Okay. Yeah. Yeah.
And what I'm selling, I know I'm selling property, plant, and equipment. Or in this case, I'm selling property, plant, and equipment,
Yeah.
right? If I sell the property, plant, and equipment, do I have it?
No, you don't.
No, I don't. So how can I get it out of my books?
Credit inventory.
Credit, not inventory. With selling property, plant, and equipment. So it
Oh,
has to be
so
property,
property, plant, and equipment.
plant, and equipment. It's gone.
Okay.
So how much is we're gonna see later? Question mark. So
Yeah, question mark.
now I don't have this property, plant, and equipment.
Okay.
Can I keep the amortization?
Y no, you don't.
No, I have to get rid of the amortization. Now, I already claim amortization expense during the period, 43,000, correct?
Yeah.
Which account that's gonna hit me?
That account is gonna. Okay, that's where I'm a bit lost and I'm
So,
getting.
so if I do debit amortization expense, which account I'm gonna credit? Yeah,
Amortizing in.
keep
Oh,
going. I'm looking for something else.
uh, when you debit an expense, you have to credit cash.
No, 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 no. I'm not buying. I'm not buying.
Oh, okay.
I'm not buying. I cannot buy amortization.
Okay.
There's no way you to go to market and say, I want to buy amortization. I have
No, that's not possible. Yeah.
unlimited amount of cash, right?
Yeah.
They're gonna
Yeah.
start like, oh, what are you
Yeah.
talking about? So debit amortization expense. Where is the
Okay.
credit? Which account
But
is the credit?
it's not cash. We know that. We have to basically, I think it's credit inventory. Sorry,
Accumulated. Check the
sorry, accumulated
amortization. Xiaolin, thank you. So Xiaolin
accumulated
posted on the chat.
amortization.
I think that's direct only for me, but anyway, it's not on the direct chat, but anyway, it's the accumulated amortization. That's correct.
Oh, okay.
We're doing debit amortization expense, credit
Oh,
accumulated amortization.
oh, okay. Okay.
Okay,
Credit.
great, great. Now in the accumulated amortization, now I have amount of $43,000.
Yeah.
Can I keep it?
No, you can't.
No, I have to get rid of it. But
Yeah.
that account now have a credit balance. How can I eliminate that credit balance?
You can eliminate the credit balance by debiting.
Okay, so which account I'm gonna debit?
Uh,
Xiaolin,
so
accumulated amortization.
the
Not,
accumulated
no, no, no.
amortization.
Amortization expense gonna go with the income statement. Now I end
Okay.
up on the balance sheet with credit balance on the
Okay.
accumulated expense, which offset, which is offset property, plant, and equipment.
Okay.
So if I eliminate the amortization, I'm gonna see the how much is the net amount of my property, plant, and equipment, correct?
Yeah. Yeah.
So now I'm getting rid of the property, plant, and equipment. I have to get rid of the accumulated amortization as well. Let's get rid of it.
Okay.
Accumulated amortization on the property, plant, and equipment. Gone.
Okay.
How
Yeah.
much is that? We already know how much is it. We're gonna let's put the question marks and we're gonna come to this and gonna fill the gaps. Why doesn't let me put the question marks now? Okay, question marks. And the last thing that we know, do we have debit gain or loss
Uh,
here on the income statement? The gain or loss?
We have basically, I'm guessing a gain.
No, 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 don't guess. It says here.
Oh, it says gain on
Gain.
property.
So, gain, debit or credit?
It's credited because
Always. End
yeah,
of the story. You don't have to explain. Gain, credit.
yeah,
Credit, gain on sale
yeah,
of property, plant, and equipment.
yeah,
Okay, we have our journal entry, correct?
yeah,
That's what's happened. On the day of sale, that's what's happened. Now we have to
yeah.
put the amounts,
Okay.
correct?
Yeah.
Let's put the amounts. How much is my gain?
Your gain is basically 19,
19,000. Okay.
19,000.
How much is my, how much I need here to credit it in order to eliminate to make this in balance?
Uh, you credited 173,000.
173,000. Okay. How much is my accumulated amortization?
Your accumulated amortization, sorry, I'm just gonna ex
Which will be equal to the amortization expense for the period,
43,000.
43,000. Okay. So
And then make sure debits equal credits
what's
and
left for
figure
me?
out that for X, right?
What's left for me?
How much
Cash.
cash?
Cash. Can you tell me how much cash we get?
So it would be basically you add up 173 and 19,000 and then subtract that amount from 43,000 to get the answer.
Correct. And how much is it?
Okay, I'm just gonna
149.
140.
149,000.
Yeah.
Make sense?
Yeah, it does now. Thank you.
So let's see something else. Let's see something else. How much is the property, plant, and equipment? It's 173, correct?
Yeah.
How much is the amortization of that one?
Amortization is 43.
43,000. How much is the net property, plant, and equipment?
You sum that up together and you get 200.
Why are you adding
No.
it together? Amortization is
Oh, sorry.
contra account to the property, plant, and equipment.
Oops. Okay, I made a mistake.
Yes.
173 minus. So it would be 130,000.
Okay. If my net amount is 130,000 and I'm generating gain, am I getting more cash than 130 or less cash than 130?
You're getting more cash than 130.
How much more cash I get? How much is my gain?
It would be the 130
No,
minus
no, 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 no. Here. You have it on
oh
the
the
income statement.
19.
19.
130 minus the 19,000.
That means how much cash I get? The net amount of the property, plant, equipment plus extra $19,000.
Oh,
Is
okay.
that make sense now?
130 plus the 19,000 to get how much you're
Right.
gaining. Yeah, okay. Yeah, I can see it now. Thank you.
So another question for you guys. Imagine we have the same scenario, but now instead of here having gain of 19,000. In the second scenario, I have loss of 5,000. Question for you. Did I get more than 130 or less than 130 cash? How much less? 5,000. So how much cash I get? 125. Does that make sense?
Sorry, I'm a bit lost again. 125 you got. Can you repeat what you just said?
So if we have a gain,
Yeah, 19.
transfer that we have, we get more cash. than the
Okay.
net property, plant, and equipment, correct?
Yeah, yeah.
So if we have a gain, we can conclude
Oh,
cash
I
is
see.
more
It's
than
the
the net
149 minus the
value of
130.
property, plant, and equipment, correct?
Yeah.
But if I have loss,
Loss
then
would always go on the
the
left.
cash will be less than the net of property, plant, and equipment.
Yeah.
Does that make sense?
Yeah. So far, yeah. Yeah.
That's all investing activity, people.
Oh, wow. That's interesting.
That's all. That's all this part. What you have to remember is if you have a loss, that means you get less cash than the net amount of the property, plant, and equipment. How can I get the net amount of the property, plant, and equipment? What's the property, plant, and equipment less accumulated amortization? That's your net amount. And then chasing. If I have a gain, you're getting more cash. If you have loss, you're getting less cash. Make sense? Are you guys with me?
Just had to drink something, but yeah, I'm with you, Ivan.
I want you to, let's do one exercise. I want you to do one exercise.
Okay.
I want you to close your eyes. I know I cannot see you. I know you can, you know you can see me. Close your eyes, please.
Okay.
All
Close
of you,
it.
all of you. Imagine you purchase laptop for $1,000.
Okay.
You use the laptop for 1 year.
Okay.
Your claim amortization, $200.
Okay.
How much is the net value of the computer now?
800.
Somebody pay you $900. Do you have
Made a
gain or
gain.
loss?
It's a gain.
How much is your gain?
100.
Okay. Same scenario. You have one laptop, you purchase laptop for $1,000. You use
Okay.
it for 1 year. You
Okay.
claim amortization $200.
Okay.
You sold the laptop for cash,
Okay.
but you generating gain of $200.
Okay.
How much cash did you get?
Okay, that's a bit of a tricky one.
Okay, let's go back to the first one then. Let's go back to the first one.
Okay.
First one was still keep your eyes closed.
Okay.
You have 1,000, you purchase laptop for $1,000.
Yeah,
You
yeah.
use it for 1 year.
Okay.
You claim amortization of $200.
Okay.
What's the net value?
It's 800.
Somebody pay you $900.
It's a gain because 800 is
How
less
much is
than
how much you
100.
gain?
You
$100.
100,
Okay,
100.
okay. So that's how you're getting the gain. So now let's go to the other scenario.
Okay.
You have a same laptop, 1,000.
Okay.
You claim $200 amortization.
Okay.
You sold it for cash and you're generating $200 gain. How much cash did you get?
Uh, 200?
Again.
1,000?
So
Oh yeah,
let's
it's a
think
thousand. Yeah, I can
it's
see why it's
1,000.
1,000. It's
Can you
800 plus the
can you
200,
can
that's
you
1,000.
exactly? Can you picture the 1,000?
Yeah, I can picture it now. Yeah, it makes sense now because like you get 200 gain, the laptop's being amortized. It's 800 plus the 200 you got, and that's actually 1,000.
Excellent. So let's go the other scenario. You have a laptop, $1,000.
Okay.
You claim amortization, you use it, you claim amortization up to today, $500.
Okay.
What's the net amount of the laptop?
It's 500.
Now, you sold it for cash. Careful now, you sold it for cash,
Okay.
but you're generating loss. of $100, how much cash you get?
400.
Is everybody agree with that? Has everybody picture $400 coming in your pocket?
I did that with my eyes closed.
Okay, good. That was the whole point.
Okay.
Now you can open your eyes and now you can start. Now you can start seeing what's the gain, what's the loss, how much cash you're getting. Do you understand
Okay.
now? So if
Yeah.
you get
Yeah.
if you have a gain, that means you get more than the asset minus the accumulated amortization.
Okay.
If you have a loss, then you get less than the asset minus accumulated amortization.
Okay.
In
Okay.
other words, if you have a gain, that means you're getting more cash than the net amount, net property, plant, equipment, or net equipment, or net machinery. If you're having loss, that means you're getting less cash than the net of the property, plant, equipment. Okay. So let's go back to slides and see how the slides explain the whole situation. On the slides again, we have the income statement shows amortization expense of $43,000, gain of 19,000. So first we have to determine the book value of the property. The book value of the property, we're gonna get it. The net book value, that should be, we have to get here net book value of the asset. But why the net book value? Because the book value will be 173 less accumulated amortization is going to give us book value of 130 only, since we have the amortization expense for the period. So how are we going to get the cash? First, we're getting the book value or the net book value of the asset. Again, that's the net book value of the asset sold, plus the gain, minus the losses, going to give you cash. That's why it's important for me to understand and to calculate this net book value of the asset sold, which will be the original or what's left minus the accumulated amortization. So acquisition of the long-term assets. On the acquisition, those are some similar approach. If we have the long-term loans receivables and the loan collection, we're going to get the cost of the investment sold plus the gain minus the losses. What we can get and what we can sell. We can have not payable, long-term, bond payable. We can issue those one and get it. That's for the financing activity. So let's stay with the investing activity for a second. For the acquisition, here we're talking about only and only for the long-term assets plus investments, and that's all. That's your investing activity. Now let's move to financing activities. Financing activity from our chart here, the one that we created on the Excel spreadsheet last time. On this chart, what I'm sharing with you, I'm not sure if sharing the right Excel spreadsheet, but let me see which Excel spreadsheet I'm sharing. I should share with you this one. On our cash financing, dealing with the long-term liability and equity section. And that's all. What's included on the long-term liability? In the long-term liability is included note payable, bond payable, long-term debt. And now we're moving to the equity section, which is the common shares retained earnings. Yes, you may have preferred shares, of course. So, how are we dealing with this? In this case, we're going to have cash payment on the debt can be computed by following formula. Beginning balance plus the issued new debt minus the ending balance going to give you how much payment you made. For example, For example, no, they're not going to give us extra information because this case doesn't have the extra information, but we're going to see later in the examples how exactly it's going to happen. But remember, beginning balance plus the new debt that you get minus the ending balance is going to give you, is there anything that you pay on the current debt? On the shares, beginning balance of the shares plus the shares that you issued during the period minus the ending balance is going to give you how much new shares I'm sorry, how much shares you retired. Now, on the dividend, that's a different story, dividend. Because the dividend usually goes with the retained earnings. Do you remember this? A dividend comes out from the retained earnings. Every time when the company declared the dividend, reducing the retained earnings. And every time when the company paid the dividend, that doesn't reduce anymore the retained earnings because we already reducing. That's gonna reduce the dividend payable. As long as we don't have a dividend payable, that means whatever we declare as a dividend has been already paid. And we're going to see with the examples. So what's the impact on the international financial reporting statements, for reporting standards on the cash flow? Now we have to go to the international financial reporting standards in order to understand it. At this point, I cannot, it's even if I tell you these slides is going to be just for you just reading the slides and talking what is going on here. Very briefly on the indirect method, because I know some of my teachers want you to know the direct method, even though we're not teaching the direct method. And in the practice, mostly is used indirect method. The difference, again, I showed you last time, is the starting point. In the direct method, we accounting for the revenue and expenses. Where in the indirect method, we getting the revenue minus the expenses, and we starting with the net income. And then we eliminating the non-cash items for the net income. Where in the direct method, we're not including in the first place. That's the only difference. So we're getting the revenue and expenses from the net income. And then after that, once we come up with the cash income, we start doing the changes in the working capital or increase and decrease on the assets and increase decrease of the liability, current assets. And we come up with the cash from the operating activity. That's the only thing that I'm going to spend on the direct method. If you're interested, you can follow the slides. I'm not going to follow the slides. That's where you stop. For this course, you're going to be tested only and only on the indirect method for the operating activities. Now, don't tell me on the investing activity and financing activity, there's no direct and indirect, so there's only one way. So don't tell me I didn't give you indirect method for the investing and financing because they're the same. Only the difference is operating activities. You can come up in two ways onto that cash income. From the income statement by eliminating the non-cash items, or from the net income by adjusting for the non-cash item and adding back the expenses and losses and deducting the gain. That's your chapter 17. The recording. So, and now we can see. Again, the question is, we have the income statement of this company and we have the balance sheet of this company. And additional information stay. Again, I changed the additional information. Equipment was purchased for cash. We don't know how much cash. Common shares were issued for cash. We don't know for how much cash. And declare paid cash dividend during the year. We don't know how much cash they declare and pay during the year. Let's see if we can find out those one. So let's start here preparation of the cash flow statement. First thing that you have to remember is the cash flow statement starts with the name of the company. Second, once we get the name of the company correct, we're gonna put the name of the statement. Cash flows statement. Now, once the time when there was a time that I was doing this in class, and one of the marks deduction is because of the plural. If you put me only cash flow statement, you're getting 1 mark deduction. Why? Because we're preparing 3 cash flow statements: operating, investing, financing. That's why the name is plural, cash flows statement. And the next one is for the period. Cash flow statement, remember, is for the period of time. So for the year ended, and you're choosing, in this case, December 31st, 2040. And that's our starting point. Next thing that we're doing is we're starting with first item, which is cash flow from operating activities. I'm gonna copy and paste it directly here. That's what we have to do. Now the question requires we to use for operating activity indirect method. If we're using the indirect method, what's our starting point? I brought it here. Give me the starting point. Net income. Yes. Let's go with the net income. How much is our net income? In this case, the net income is $93,800. That's our starting point. After that, we have to make adjustments for non-cash items. First thing first, let's see, do we have a non-cash items? By saying non-cash items, I'm chasing anything that it doesn't affect cash. Sales, there's a cash there. Cost of goods sold, cash. Depreciation expense, is there cash there? No. So what we have to do now, think about it. The depreciation expense decreasing my net income. How can I eliminate this effect? By adding it back. Add. So what we're gonna add? First thing, that item that we're gonna add depreciation expense, and we're gonna add back $25,200. Other expenses are other expenses. What else? Income taxes are income taxes. Do you see any other non-cash items? No. So let's get those two together and see where we are. So adjusted net income, we come up with $190,000 adjusted net income. After that, we have to start chasing changes in working capital. In other words, we're done with the income statement. Income statement is only for this first part. Now we have to grab the balance sheet and start following the changes in the balance sheet. Go leave a little bit more space, make it a little wider, so I can have a little bit space first. So what I'm chasing here, two things, current assets and current liability. So there's a question, since depreciation expense is non-cash items, why do we have to add it back? Because we're chasing only cash. If there's sales is only cash, cost of goods sold is only cash, other expenses is only cash, income taxes only cash. Depreciation expense is the only one who is not cash. If I get the sales which are cash minus cost of goods sold, which is cash, minus the other expenses, which is cash, minus the income taxes, which is cash, how much will be my net income? Whatever it is right now, 93,800 plus the 25,200. So my income should be 190. Let's check. If my sales are only cash, that's 929,600. Cost of goods sold only cash, 557,200. Other expenses, 233,800, only cash. Then I have income tax expense, which is 19,600. So this is negative. This one is negative since it's expense. And this one is negative since it's expense. If I combine those together, how much do you think I'm gonna get? Let's see. So what I did here, by adding the amortization expenses back, basically I get net income, sales, minus cost of goods sold, minus other expenses, minus income taxes, 190. Depreciation expenses, I'm not paying them with cash. I don't care about that. Now, this is your part of your direct method. This is pure indirect method. Starting from the bottom line, working back to get the adjusted net cash, net income. Both calculations going to give you exactly the same result. Again, this you can call it direct method, this can call it indirect method. This is clearly indirect method because that's what you're doing in the indirect method. On the direct method, we just chasing only the cash items. Sales, cost of goods sold, other expenses, income taxes. Boom, we come up with the same amount. Okay, so now changes in the working capital. Now we start going over the assets and liability. First asset is cash. That's the purpose of the cash flow statement, to explain what happened with the cash from 2013 to 2014. Second one is accounts receivables. Let's go. Accounts receivables. Now on accounts receivables, what we chasing? We're chasing uh beginning balance of accounts receivables. Let's put this brackets. Beginning balance of accounts receivables minus the ending balance of accounts receivables. In our case, what is going to be? Bracket 37,800 minus 43,400. I'm going to stay with this column right here. And I'm going to have here 37,800 minus 43,400. So my cash is 5,600 down. Why? Because from the sales, remember, we already said now these sales I collected. This is my cash. If my accounts receivables was beginning balance equal to the ending balance, that means I'm collecting all the sales. But that's not the case. Now my accounts receivable is going up. With how much? With 5,600. So from the sales, which I'm considering cash item, I haven't collect $5,600. Where they are? In accounts receivables. Remember, every time when you're building accounts receivables, that means you're not collecting the cash. Which cash? The sales, from sales. So if you want, here just for the purpose of the exercise, I can put here the sales, which are 929,600. We have a cost of goods sold, which is 557,200. So you can have it. That will be negative, obviously. Then we're going to have negative 233,800. Then we're going to have income taxes, which is 19,600. And once we combine all together, we're going to end up with exactly the same calculation for the adjusted net income. That will be indirect. That will be directly on the direct method. So again, from the sales that I have, which I'm indirectly considering cash item, I haven't collect 5,600. Why? Because my accounts receivables went up. Now let's see the other one, merchandising inventory. On the inventory, what we're gonna do, same thing. Beginning balance of the inventory minus the ending balance of the inventory. What I'm gonna have in brackets? I'm gonna have 249, 200 minus 284, 200. Am I building a inventory or reducing the inventory? Increase. So I'm building the inventory. If I'm building the inventory, what's happened with my cash? Am I getting cash or am using the cash to build that inventory? Is going to increase my cash or decrease my cash? What do you think? Using the cash. Okay, great. So let's see how much we can use that. Here, let me put the bracket, sorry. Let me put the bracket. This one, not that matters, but let's keep it with the bracket. 284, 200. Boom, down. My cash went down with $35,000. Why? Because I built my inventory. My cash now is not in sales, it's in inventory. I have to sell it, collect the accounts receivables, and then I'm going to see the cash. Until then, I'm short with $35,000 cash. Next one is the equipment. Is the equipment part of my working capital? No. We're going to leave it for the investing activity. Now let's go with the liabilities and equity. First item, accounts payable. Now we're chasing it. That's part of the working capital. No questions about it. Accounts payable. Now again, don't forget the rule. For the accounts payable, since it's cash outflow for us, we have to put minus in front of the bracket. So it's going to be minus bracket beginning balance of accounts payable minus ending balance of accounts payable. Or it's going to look like negative. So here will be minus bracket 44,800 minus 32,200. By looking only accounts payable, only looking at, What's happened with the balance, beginning balance, going up or going down at the end of the year? Going down. What that means to our cash? Did we use the cash to pay the balance or we not paying the balance? We pay. Think about it. So less cash. Yes, we paid it, so less cash. That's correct. When do we know? So we're adding the negative on the liabilities. Once you move to the liability section, you start adding the minus in front of the bracket. Why? Because the liability has beginning balance credit. Beginning balance is on credit side. Asset has the beginning balance on the debit side. For that reason, everything which is liability is on the negative compared to the assets effect. So let's go. Equal to negative bracket 44,800 minus 32,200, close the bracket. So our cash went down with 12,600. Does that make sense, Monica? Yes, it does. Thank you. Let's go with the next one. Income tax payable. Income tax payable. Since it's liability again, negative in front of the bracket. Beginning balance of the income tax payable minus the ending balance of the income tax payable. So in this case, we're gonna have negative bracket 11,200 minus 12,600. What we're doing with our payables? Are we building payables or we're decreasing payables? What's happened with the balance? Went up or going down? Building, went up. So, are we saving cash or using cash to reduce the balance? Saving cash, okay. Now, how much cash we save? Equal to bracket minus bracket 11,200 minus 12,600. 1,400. How can I explain this? Now, my income tax payable expense in my income tax expense is 19,600. Did I pay my interest tax expense? I paid 19,600 minus 1,400. So I pay as an income for the Canada revenue, I paid only $18,200 cash. Okay, anything else? Next one is common shares. So where is that on the column C? Do you use something so the number don't do anything or stay and say as text? Oh, here on number C, yes. Here I'm using this symbol. So when you're putting this symbol, can you see it on my screen? Apostrophe, yes. When you put the apostrophe, then you can write anything you want, it doesn't change. Because if you put minus, consider it as a formula. If you put the apostrophe, whatever you put after doesn't, it's not formula anymore. Take it as a text. So, what's our net effect here? Let's see. Once we add everything, we have reduction in our cash with 51,800. So our net cash from operating activities, I'm going to copy the name, That's going to save me a little bit time on the name at least. Net cash from the operating activities is going to be equal to this one plus that one. So my cash from the my net cash flow from operating activity is equal to 67,200. Compared to direct method is going to do exactly the same with the working capital. And that's how, once you get those two together equal, changes in the working capital in the both methods are exactly the same. So you don't have to worry at least for those. So let's go on the next one. Now we have to start, that's the first time that we're going to do investing activities. Let's see now cash flow from investing activities. Let's see what we're going to do now with the investing activities. Now, equipment, let me grab this one. Which are the investing activities? Again, we're taking investing activities is equipment. Long-term assets. Equipment and companion account to equipment, which is accumulated depreciation. Okay, let's grab this equipment here and let's post it here. Right here, to top. Okay, it's not gonna let me, so I have to do something other than that. The equipment is purchased for cash. I purposely eliminate the amount of the cash. You know the amount of the cash, I don't. Don't tell me. I'm not gonna look at the question. So how can I find this cash? Well, very simple. I have to recreate the T accounts. Don't forget, we have the T accounts available. We can bring it back and forth as many times as we want until we figure out what's happening. So I have two accounts. The way I see it, I have two accounts. I have one account, which for the assets, which is my equipment. Let's make that T account first, which has beginning balance, asset account, beginning balance, ending balance. And that's my equipment. And that account goes always and always goes with its companion account, which is accumulated amortization of the equipment. They always go side by side together, like a more than a brother and sister. And they cannot live without each other. Don't forget that. Accumulated amortization equipment. Let's make it a little bit bigger here. So, equipment has beginning balance and has ending balance. Let's leave one line here just to make it, oops, not this one, the other one, insert. And my beginning balance, ending balance, those are all on debit side. Accumulated amortization, same story. They have beginning balance and ending balance, but on the opposite side. Beginning balance is here, ending balance is on credit side. That's how we're getting the net of equipment. In this case, we don't have to. So my equipment beginning balance is 138,600. My ending balance of the equipment is 155,400. I know I purchased equipment for cash. Let's see the accumulated amortization, companion account. My beginning balance is 47,600. That's the first thing that I know. Second thing that I know is trying to get access to here to this column to make it wider. Second thing that I know, my ending balance is 72 800. And then half amortization expense during the period. My amortization expense or depreciation expense here is 25,000. Let's change the terminology. That will be accumulated depreciation here. I have depreciation for 25,200 during the period, which give me debit depreciation expense, credit accumulated depreciation of 25,200. If I plug 25,200, is that solve my problem? On this case, my debit here, this is my debit, this is my credit. Same thing, this is my credit here, this is my debit. If I plug that amount on the credit side, is that solve my problem? Oh, sorry, on the debit side. This amount plus this amount doesn't give me that amount. So we're done. There's nothing here. What that means is if the beginning balance plus the depreciation expense equal to the ending balance, that means only in this account you have the depreciation expense for the period. That means you haven't sold any items and you didn't deduct any of the depreciation which is related to the sale of the assets. So now the only thing that left is that we purchase asset for cash. Now, in this case, beginning balance is not equal to the ending balance. What is the amount here that's going to solve my problem? And what I have to do, I have to get beginning balance. I already know the credit is 0. I haven't sold anything for the period. So I'm going to have beginning balance plus the debit equal to the credit, which is 0, plus the ending balance. Beginning balance plus something that I don't know should be equal to 0 plus ending balance. So how much is this the thing that I don't know, or debit in this case? Should be equal to 0 plus 155 400 minus 138 600. So 16,800. So if I add here 16,800, am I in balance? Beginning balance plus the debit minus credit, does it give you the ending balance? Yes. So now that's how you find out how much cash I spent for the purchase of equipment. So now we have cash for purchase of equipment, and that cash here is equal to negative 16,800 because I'm paying for this. Now what that means, cash pay for the equipment, and that's the only item that we're going to have for the investing activities. So we can have a net cash inflow if you want. Let's get this line here and put it right here. And we're going to have net cash inflow, or that will be net cash outflow in this case, from investing activities is equal to negative 16,800, which will be this amount only. Investing activity done. Next section is financing activity. I'm gonna copy this and gonna paste it here. Financing activities. So for the financing activities, Actually, I'm gonna push it down because I want those calculations here to stay with what we're doing. For the T accounts to stay with the cash flow that we're doing. I'm gonna move those one even here. So now they're on the same line. So I can easily go back and forth and understand how did I get this 16,800. Financing activity. On the financing activity, I have few things here. First one, common shares was issued. I know the common shares were issued. And I also know that the company declared and paid cash dividend. Those are definitely part of my financing activities. Now, again, I'm going to grab the balance sheet and I'm going to start working the balance sheet and think about it. What I'm going to think about. First, I'm going to bring the common shares account. Let me see if I grab it correctly. All the parts, yes, I did. And I'm going to post it right here. And then I need another account, which is the retained earnings. Luckily, both accounts have a normal balance create, so I don't have to change anything on the question here. So let's bring it a little bit up. All those lines, just one line up. So what I'm chasing first. I'm done with the accounts receivable, done with the inventory, I'm done with the equipment, I'm done with the amortization, accumulated depreciation. Then I'm chasing accounts payable. We're done with accounts payable, income tax payable, done. Common shares. Let's go with the common shares. Beginning balance for the common shares is 336,123. We don't know what's happened. I mean, I don't know, you know. I don't know how much cash I spent. And the ending balance is 364,123. The question doesn't say we repurchase the shares, so on the debit side, that will be zero. So that means I need increase in my common shares on the credit side because this credit here is going to give me increase on the common shares. What will be the amount that's going to solve my equation here? Again, my equation is beginning balance plus now the credit should be equal to debit plus the ending balance. I'm chasing this number, which is my credit. What's the amount that's going to solve my problem now? How I'm going to get it? Obviously, I'm going to chase with debit plus the ending balance minus the beginning balance because I'm looking for the credit. Credit is the one that I don't know. So in order to find the credit or how much cash I get from the common shares, I need to get, let's put the formula here. I need to get 0 plus ending balance 364,123 minus the beginning balance 336,123. Once you solve this equation, how much you get? Are you guys with me?
So I'm just typing it on my calculator.
28.
Okay.
So 336 plus 28 doesn't give you 364? If it does, that means that's how much cash now we get. That will be cash from issuing of common shares. And we get cash for 28,000. Now, this is the common shares were issued. Now 11,200 shares were issued. Now I can come up even with the cost per, the how much I get per share. The next thing is I declare and pay cash dividend. For the cash dividend, I need the retained earnings account. I'm almost at the end. So for the retained earnings, I have my beginning balance 40,600. And my ending balance is 82,600. What else I know about the retained earnings? What increase the retained earnings? What give an increase in the net on the retained earnings? Move from the sales to something else, Monica. Sales minus something else gonna give you the increase of the retained earnings. From where the retained earnings increase? From the income summary account. In the income summary account, we put in the sales minus expenses, and then we calculating what? Remember, retained earnings, credit always increase with the net income, and debit always decrease with the dividend. So, do I know my net income for the period? I should check the income statement or the starting point of the indirect method, and to see I get $93,800 net income. Now I know that I declare dividend. You know the amount, I don't, but I don't know how much is this amount. How can I find it? Same thing. I'm gonna get this copy and I'm gonna paste it right here. But in this case, I know my credit because the credit is my net income. I don't know my debit, which is the dividend. So how can I find the dividend, which is my dividend? That will be equal to beginning balance, which is 40,600 plus 93,800 minus 82,600. And once you solve this, what I'm going to get here is going to be equal to this one plus that one minus this one. So you naturally should get $51,800 we spent on the dividend. That's how you're getting 40,600 plus 93,800 minus 51,800 is going to give you a 82,600. So now let's go here and say cash for dividend or cash dividend or dividend. We spent on cash dividend, we spent $51,800. That's negative. So my net cash flow from the financing activities here, it's gonna be calculation of those two, which will be here, and then I'm gonna move it X right here. That will be it, and that's gonna be equal to that amount. Now I have everything. The only thing that I have to change here to change it to, instead of investing, to go financing activities. Next thing that I have to do is net change in cash. So what I'm gonna do now here, I'm gonna get my operating cash from operating activity plus cash from investing plus cash from financing. And I'm gonna see that my net change in cash is 26,600. The last thing that I'm gonna do, I'm gonna start cash at January 1st. Which is my beginning balance. And at that time, my cash was 54,600. Cash at December 31st, which is my ending balance, is 81,200. Is that explain this 54,600 plus 26,600 doesn't give you 81,200. When you're getting the ending balance 81,200 minus
Yep, that's
52,600.
what I got.
26,600, is that the change? So that's explained everything. So how, from where our cash increase? Our cash increase from the operating activity, we're generating 67,200 cash, which we invested in the equipment, 16,800, plus we pay dividend, 51,800, and we issue common shares for 28. So that's why we have change in our cash, positive change with 26,600. And that's how we move for 54,600 up to 81,200. And that's the end of that question. Congratulations, we did the first cash flow question. It would be a way easy if I had those cash here, which you have it. But I wanted to show you that in reality, you don't need those cash. In the questions, you don't have to give it that much information. You can easily come up with that information, the way I come up. Now let's go for break now, and let's do another question. How do you feel about this question?
That was a bit of a lot to take in, but I will try the best I can to process it.
Again, with this question, what we did is we start with the income statement first. We get the $1,000 from the income statement. We adjusted for the non-cash item, which was the only depreciation, $80. We add the depreciation back, and that increase our adjusted cash to $1,080, which will be exactly the cash that we're gonna do if we have to do the direct method. After that, both methods considering changing the working capital. Changes in the working capital comes from the changes in the current assets and current liability. So first current assets was the accounts receivables. Increase, we have accounts receivable balance, beginning balance minus the ending balance. And we have increase in accounts receivables of $720. After that, the next one is the inventory. And we see the inventory beginning balance minus the ending balance give us 480 reduction of the ending balance, which improve our cash. Now, after that point, we're moving to the current liability. Since we move to the current liability, don't forget to put minus in front of the brackets when you're calculating beginning balance minus ending balance, because now we're on the cash outflow. Once we chasing the assets, we are cash inflow. Once we switching to the liability, we're on the cash outflow. So for that reason, you have to put a minus in front of the brackets. So first, current assets was the accounts payable. We're seeing that increase in the ending balance with $480. So that means minus bracket beginning balance minus the ending balance. Positive effect on cash of $480. Next one is the accrued liability. Again, minus beginning balance minus ending balance. 480 minus 320. That's reduction with 160. Cash going down. Net effect on the changes in the working capital is $80 positive. So our net cash inflow from operating activities end up to be $1,060. After that, we're moving to the additional information for the capital assets first. On the capital assets, first thing that we have is there's no sales of property, plant, and equipment. Which checking the income statement, there's no gain, no losses. So that means that's correct. The only thing is purchase of equipment for $320 cash. $320 cash. So once we check the property, plant, and equipment, we see the 2720 plus 320 give us exactly $3,040, which is the cash that we use to purchase the equipment. So that will be cash for the purchase of equipment, 320 under the investing activities. Next thing, accumulated depreciation. Just double check on the accumulated depreciation. Is the increase in the accumulated depreciation equal to the depreciation expense? If that's checked, that means we definitely haven't sell any properties. Last thing in this question was the long-term investment that we sold for $160 cash. But even if the cash hasn't been given, we can easily see that our long-term investment going down with $160, which explain the cash that we receive from the sale of the long-term investment. Once we get the purchase of the asset minus the cash that we sell the long-term investment, we have negative effect from the cash outflow for the investing activity, $160. Once we're done with the current long-term assets, we're moving to the long-term liabilities, which the long-term and equity. Long-term liability was bonds payable, and that's all. And then the equity was common shares and retained earnings. On the bonds payable, we retire 160, means that we purchase back 160 bonds payable, which explain the reduction of bonds payable from 2,400 down to 1,240, exactly 160 cash that we use to purchase back the bonds and retire the bonds. Next one, we issue common shares for 320, which is increase in the common shares with 2,720 to 3,040, which is exactly $320 increase in the common shares. The last thing left is retained earnings. In effect, there's a cash dividend which was declared and paid. In this case, the amount is not given. For that reason, we have to do some calculation. What will be the calculation again? Beginning balance is given, $3,040. Ending balance is given, 3,920. We know that the income, if we have income, is going to increase the retained earnings. If we have loss, it's going to decrease the retained earnings. So we're checking our income. Our income was exactly $1,000 based on the income statement. And we're adding the income on the credit side to increase the retained earnings. And now on the formula, we have $4,040 beginning balance plus the credit to be equal to debit, which we don't know, a dividend that we paid, plus $3,090. Once we sold this one, we find out that cash that we pay for the dividend was $120. That's going to decrease our cash for the financing activities. So the effect on the financing activities is positive of $40. Once we combine operating plus investing plus financing, we're seeing that our cash net change is $1,040 positive. Then we see is that actually reflect on our cash. So our starting point is 1,840. Ending balance is 2,080. So 1,840 plus 1,040 is going to give us 2,080, which explains why the cash increase. So if somebody asks you why the cash on this company increase, well, that increase because from operating activity, this company generating positive cash of $1,160. During the period they invested During the period they invested in the long-term assets, 320, and retired long-term investment, 460, plus for the investing activities, technically they spent $160. Now on the financing activities, for the bonds payable, they retire bonds for 160, issue common shares for 320, and pay cash dividend $120, which is increasing the cash from the financing activity. Net change is $40 positive. And that's how they come up with increasing cash from 1,840 to 2,880. It's called financing activity because that's from where the capital comes from. Capital comes from the long-term liability and equity. Remember, the working capital is your current assets and current liability. Investing. In the investing, you're only chasing long-term assets, and financing is from where the capital come from, and the capital come from the long-term liability plus equity. And now you have all the elements of the balance sheet. In the changes to working capital and the operating activities, you're catching current assets, current liability. On the investing activities, you're catching long-term assets. And the financing activity, you're catching the long-term liability plus equity. Technically, you shouldn't have any items left. Once you finish the cash flow, all the items from the income statement and the balance sheet has to be checked. That means you consider all the effects on the cash flow statement. The third one is the equity. Equity section, which coming from the common shares, preferred shares, and retained earnings. Now you have two questions for the cash flow statement. So I hope that's gonna help you. In order to find the recordings, what you have to do, you have to go to the Blackboard. And once you go to Blackboard, under additional questions on the chapter 17, you're gonna have the Excel solution for question chapter 17-2 and 17-3 right here. Now that 17-3 is gonna pop up. And you have the two questions with the Excel spreadsheet sitting and waiting for you to be open. So if you want to watch more videos this semester, next semester, don't forget to subscribe to my channel. Now I have to do some channel talking, and that's about for me.